One key question you'll likely face is, what are the key steps in the KYC process? Know Your Customer is not just about collecting customer information, it's a structured process that ensures banks and financial institutions deal only with legitimate individuals and businesses. Let's break it down into simple steps. Step 1. Collecting customer identification documents. Before opening an account, banks ask customers for documents to prove their identity. These typically include government-issued ID, passport, driver's license, etc., proof of address, utility bill, rental agreement, bank statement, a recent photograph. Think of this like registering for an exam. You must provide an ID to prove who you are before getting a hall ticket. Similarly, banks need valid documents before offering financial services. Step 2. Verifying customer identity. Once documents are collected, banks cross-check the details to ensure authenticity. This can be done by matching information with government databases, conducting biometric verification, fingerprint, facial recognition, checking if the customer appears on watch lists, e.g., sanctions lists. Example: imagine someone tries to open multiple bank accounts with different names but the same ID number. A strong verification process would flag this as suspicious and prevent fraud. Step 3. Assessing customer risk level. Not all customers pose the same level of risk. Banks categorize them as low-risk customers, regular individuals with simple transactions; high-risk customers, businesses dealing in cash, politically exposed persons, PEPs, or customers from high-risk countries. For high-risk customers, banks conduct enhanced due diligence, EDD, which involves deeper background checks and transaction monitoring. Example: a businessman regularly receiving large international payments may undergo stricter checks than a student opening a savings account. Step 4. Ongoing monitoring of customer transactions. KYC isn't just a one-time process. Banks must continuously monitor customer transactions to detect any unusual activity. This includes tracking large or suspicious transactions, identifying patterns that indicate money laundering, updating customer details periodically. Let's see a case study. In 2020, a European bank flagged a customer making frequent small deposits into multiple accounts and withdrawing cash from a different country. This was later found to be a money laundering operation. Thanks to KYC monitoring, authorities were able to investigate and take action. The best interview answer for what are the key steps in KYC. If you're asked this in an interview, here's a simple and clear way to answer. The KYC process involves 4 key steps. First, collecting customer identification documents like IDs and proof of address. Second, verifying the identity through databases and biometrics. Third, assessing risk levels to apply standard or enhanced due diligence. And finally, continuously monitoring customer transactions for suspicious activities. This helps financial institutions prevent fraud and comply with AML regulations. Conclusion: understanding the KYC process is crucial for anyone entering the financial crime compliance field. By explaining it in a simple and structured way, you'll make a strong impression in your interview. Good luck, and see you in the next lesson.